Yeah, hello everyone. In today's video, we'll be continuing with final accounts revision lecture. If you're looking this video for the first time, please kindly have a look at the video already posted regarding final accounts part 1. So in the earlier video, we have discussed about how to prepare trading account, profit and loss account and balance sheet. So trading and profit and loss account, the main purpose is to find out the financial result, whereas balance sheet, the main purpose is to find out the financial position. Now let us move on to the next important discussion, that is adjustments. Now, see, when you prepare accounts, step number one, we pass journal. From journal, we prepare ledger account. From ledger account, finally you prepare trial balance. Which means whenever I prepare a trial balance, normally this trial balance will tally because of the dual aspect concept. So can we say if any item is inside the trial balance, this item has to come from ledger. And if it is inside the ledger, it has to come from the journal, which means an item can enter into the trial balance if and only if the journal entry is passed. So without the help of a journal entry, an item can never enter your trial balance. Clear? Which means if the item already appears in the trial balance, it means journal entry is already passed. And these kind of items will have only one effect in final accounts. Which means if it is inside the TB, it will come either in trading account or profit and loss account or balance sheet. However, sometimes what happens, there may be some items which are given outside the trial balance as adjustment. Now, what is the meaning of that? So, if the item is outside the trial balance, what does it mean? Journal entry is passed or journal entry is yet to be passed? So, can we say journal entry is yet to be passed? So, since the entry is not yet passed, the item is appearing outside the trial balance. Which means in case of adjustment, the first thing that I'm supposed to do is make an entry for that. And since we are yet to make an entry, these adjustments will normally have minimum two effects on the final accounts. So the conclusion, if the item is inside the trial balance, it means entry is passed, only one effect. If the item is given outside the trial balance, entry is yet to be passed, therefore minimum two effects will be there in final account. This is the first thing to be kept in mind when we are discussing adjustments. Now, let us move on to some important adjustments. Now, as I already told you, adjustment entries refer to those transactions for which journal entries are yet to be passed. Not yet passed, yet to be passed. Therefore, these items normally appear outside the trial balance, and this will have minimum two effects on final accounts. Will have minimum two effects on final accounts. Now, we'll discuss few important adjustments. Let's say outstanding expense. Let's say when trial balance is given to you, inside the trial balance we have salaries paid 1 lakh, and outside is an adjustment outstanding salary 25,000. Now when we prepare profit and loss account, we follow accrual basis, and when I say accrual basis, we have to show expense paid also and payable also, which means in the profit and loss account I'll be showing this 1 lakh plus this 25,000, so totally 1,25,000 on the debit side. This is in P&L account. And in the balance sheet, this outstanding salary has to appear as a liability. So can we say, when there is an outstanding salary, it should be added to the salary, which is my expense is going to increase. So if your expense is going to increase, you should debit the expense account once again. So in case of outstanding expense, since my expense is going up, I will debit the expense account. Will debit the expense account. And since outstanding expense is a liability for you, so liability account has to be credited. So the entry is going to be expense account debit to outstanding expenses. Okay. Now, if it is outside the TB, as I told you, there are two effects. Effect number one will be in profit and loss account. What we are doing here, we are adding on the debit side. So in P&L account, on the debit side, we are going to increase my expense. And in the balance sheet, we are going to show that as a liability. Okay, this is how we treat outstanding expense. Now, let's move on to the second adjustment, prepaid expense. Now, what is the meaning of prepaid expense? Can we say it's an expense of next year paid in the current year itself? Now, let's say in the trial balance, we have rent, let's say 1 lakh. And outside the trial balance, in the adjustment, we have prepaid expenses 20,000. Now, this 20,000 prepaid expense, what does it mean? This is an expense of next year, but paid in the current year. Which is this 1 lakh includes 20,000, which I didn't pay for this year, I paid for next year. And when you prepare P&L, you need to follow matching concept. And matching concept says we need to show only current year item in the P&L. So only current year item means this 20,000 should appear in the P&L, or should I minus in the P&L? I should minus. And if I have to minus this 20 in the P&L, my expense is going to reduce. And if your expense is going to reduce, expense account has to be credited, which means in the profit and loss account, I'll be showing the rent as 80,000. 80,000. So expense is going down, so expense account has to be credited. And whatever you pay in advance is like a right for you, which is an asset. And any asset need to be debited. So the entry is going to be prepaid expense account debit to expense. This will be the entry. And this will have two effects. Effect number one, in profit and loss account, on the debit side, we are going to minus this from the expense because it does not pertain to the current year. And effect number two, in the balance sheet, we show it as asset. Normally, we show it as a current asset in the balance sheet. These are the two effects. Now, moving on, next adjustment. Income receivable or outstanding income. So can we say income receivable also has to appear in the P&L? As per accrual concept, we show received also, receivable also. Now, this income receivable in the profit and loss account credit side, we should add it to the income. Because it pertains to the current year, I should add it to the income, which means my income has to increase. Since my income is going up, income is a credit balance. When it is going up, I'm going to credit this once again. Next, this income receivable is an asset for me. Any asset needs to be debited. So the entry is going to be income receivable account debit to income. Okay. Now, what are the two effects for this? See, in profit and loss account, we are going to add this on the credit side because we need to show the incomes received also, receivable also. And effect number two, in the balance sheet, because it's a receivable for me, we are going to show it as asset. Okay, next. Income received in advance. It is nothing but income pertaining to the next year, but we got in the current year. So if it is the income pertaining to next year, it should not appear in the profit and loss account as per matching concept, which means I should reduce that from income. So income is a credit balance. And if I'm reducing that from income, my income has to be debited. So I will debit the income account, debit the income account. And if you're receiving anything in advance, it's an obligation for you, which is a liability. And liabilities need to be credited. So the entry is going to be income account debit to income received in advance. Now, two effects for this. In profit and loss account, on the credit side, we will minus this from income. Minus this from income because it does not pertain to current year. And effect number two, in the balance sheet, we show it as a liability. Okay. Now, next adjustment, goods given as a charity. So if I'm distributing the goods as charity, can we say charity is an expense? And any expense need to be debited. So I'll debit charity account. Next one, if you're using goods for any purpose other than sales, so this charity, free sample, etc., etc., we need to minus from the purchases in trading account. So if you have to minus from the purchase, my purchase will come down. Purchase is a debit balance, and if purchase is going down, you have to credit that account. So the entry is going to be charity account debit to purchases account. Okay. And next one, this charity is not something that is related to either purchase or production. which means that charity is an indirect expense. And any indirect expense should be ultimately transferred to profit and loss account. So we'll make one more entry, that is profit and loss account debit to charity, which means effectively there are two effects I'm supposed to give. First one, this in trading account we will minus from purchase. And effect number two, in profit and loss account, we'll show it on the debit side as an indirect expense. Moving on, that's what is given to you. Trading account minus from purchase. P&L account debit side, show it as indirect expense. Same logic for goods given as free sample. When we say given as free sample, something similar to advertisement, so the entry is going to be advertisement account will be debited, and this I should minus from purchase, so the entry will be advertisement account debit to purchase. And second one, since it is advertisement is an indirect expense, I'll transfer it to P&L. So P&L account debit to advertisement. Same two effects. Effect number one, in trading account, I'll minus it from purchase. And effect number two, in profit and loss account, will debit like an indirect expense. Clear? So trading account minus from purchase, P&L account show it as indirect expense. Adjust number 6. Goods withdrawn for personal use. So whenever you draw something for personal use, you're going to debit drawings. Will debit drawings. And if I'm withdrawing goods for my personal use, my purchase will come down. And if purchase is coming down, purchase account needs to be credited. So the entry is going to be drawings account debit to purchase. Now what are the effects for this? In trading account minus from purchase, and this drawings will result in reduction of capital of the owner. So in the balance sheet, we are going to deduct this from capital. These are the two effects in case of goods withdrawn for personal use. Next, depreciation. Depreciation is an expense, so debit depreciation. And because of depreciation, your asset will come down, so credit the asset. So depreciation account debit to asset. And effects, this depreciation will come in P&L account debit side. And because of depreciation in balance sheet, your asset will reduce. In balance sheet, you're going to minus that from asset. Next one, interest on capital. From business point of view, business should pay interest to the owner, because business is different, owner is a different as per the entity concept. So if the business has to give the interest, can I say from business point of view, it's an expense. Therefore, expense need to be debited. So we'll debit interest on capital. But business will not actually pay in cash in real sense. What they simply do, instead of giving you money, I will simply increase your capital. Hey, anyway, owner's capital is with the business only. It's like your capital is 10 lakhs. Now I'm going to add 25,000 interest to your account. So your capital will become 10 lakh 25,000, which means interest on capital will be added to the capital. Capital is a credit balance. And since the capital is going up, I'll credit capital once again. So the entry will be interest on capital, debit to capital. From business point of view, because this is an expense, in profit and loss account will debit interest on capital, and in balance sheet we are going to add this to capital. This is how we treat interest on capital. So we are doing this strictly from business point of view. Next, interest on drawings. Now this interest on drawings is something that the owner has to pay. But what we do, we don't actually collect from the owner, we simply deduct this from its capital. So capital is going to reduce, we will debit capital. And from business point of view, this interest on drawings is an income. So credit that. So capital account debit to interest on drawings. Two effects for this. In profit and loss account, we will credit this, but in balance sheet, we will minus from capital. Okay, this is how we are going to treat interest on drawings. Moving on, bad debts. This is the most important adjustment in a final accounts question, because normally you will not find a question on final accounts without an adjustment having bad debt. So I'll spend more time on bad debts. I'm trying to cover multiple examples to understand the concept of bad debt. Okay, so let's take up case by case. Case number one. If you see, we have a trial balance wherein you have debtors of 8 lakhs, bad debt of 20,000. See, if the bad debt is given inside the trial balance, it means journal entry would have been already made. So the entry would have been bad debt to debtor, which means a debtor's account is already reduced by 20k, which is the actual debtor value is not 8 lakh. The actual debtor value would have been 8 lakh 20. From that, already 20 got reduced, and that's how it became 8 lakh, which means for this 20k bad debt, journal entry is already made. Therefore, it'll have only one effect on final accounts. The effects will be this 8 lakh debtors will directly go to balance sheet asset side, and this 20,000 bad debts will directly go to P&L debit side. So, whenever bad debt is given inside the TB, never minus that from debtors once again, because it means it's already deducted. The entry would have been already made. Only one effect, straight will go to P&L debit side. Next, case 2. Just extension of the first example. Your debtor is 8 lakh. This 20,000 would have been already deducted. Now we have further bad debt of 11k. Now this 11,000 is given in the adjustment, which means entry is yet to be made. So the entry for this bad debt will be bad debts account will be a loss for you. So debit 11,000. Debtor will reduce. So credit debtor. So bad debt account debit to debtor 11,000. This will be entry number 1. Now if you look at the bad debts balance, already we have 20,000 in the TB. Again we are debiting 11,000 now. So 20 plus 11, your total bad debt will be 31,000. This is my total loss. Already 20, further 11. This entire 31,000 loss will be transferred to P&L. So the entry will be P&L to bad debt. It's going to be 31,000. This is how we do the accounting for this. Now, to understand the impact on the final accounts, if you look at the entries, you should be able to understand. Profit and loss account debit side 31,000 will come as a bad debt. This is effect number 1. P&L 31,000. But in the balance sheet, when I show data, in the balance sheet, from 8 lakhs, we will minus only whatever is given outside the TB, 11,000, which is your debtor figure in the balance sheet is going to be 7,89,000. Any bad debt given inside the TB should never be deducted because that would have been already deducted. You should minus only whatever is given outside the TB. So it will be 7,89,000. We'll move on to the next case. Now, we have debtors of 1 lakh. Bad debt 5,000 is there. That would have been already deducted. You have further bad debt of 1,000. For this, you should make an entry. So I'll write bad debts to debtors 1,000. Now your total bad debt will be already 5,000 is there plus another 1,000. So 6,000 is my loss. That 6,000 I'll transfer to P&L. So next entry will be P&L to bad debt 6,000. So effect number 1, P&L 6,000 will come. Now there is one more adjustment where they're asking you to make a provision for bad debt. When we say provision, we are keeping aside certain amount from the profit and loss account, which is whenever you create a provision, your profit comes down. And if the profit is coming down, profit and loss account needs to be debited. Profit and loss account needs to be debited. And provision for a bad debt account needs to be credited. This will be the entry whenever you create any provision. Now, you're creating 5% of what? Debtors. And what is your debtors right now? You had 1 lakh here. And because of this entry, your debtor is now no more 1 lakh. Your debtor has become 1 lakh minus 1,000. Your debtor will be how much right now? 99,000. So you should always calculate the provision on your net debtors. So from 1 lakh, 1,000 is gone, 99,000 is net. On that, I calculate 5% provision. So which is going to be 4,950. This will be the provision figure. So keep this in mind. Provision is always calculated on the net debtor that is available. Now, If you see the total impact, P&L account la வந்து 6,000 bad debt is there and 4,950 provision is there. So totally P&L account will be debited with 10,950. We show separately bad debt 6,000, provision 4,950. This is in P&L. Coming to balance sheet. In balance sheet, your debtors will be, you have 1 lakh already. From this 1 lakh, you should only minus whatever is given outside the TB. That is 1,000. And you made a provision for 4,950, which is like a credit balance. This credit balance item, instead of showing on liability side, we will minus from debtors figure. So we'll minus that 4,950. The final figure, whatever you get, will be shown in the balance sheet. Okay. Let's take one more example. Extinction. Case 4. You have 1 lakh debtor. You have 5,000 bad debt inside the TB, which is that is already deducted. You already have a provision in the TB. And if you already have a provision in the TB, it means this provision would have been created in the last year. Now try to understand. Provision is created from the P&L. If provision is inside the TB, it cannot be created from this year P&L, take a time machine and come back to TB. Which is, if provision is there inside the TB, it means it's created already in the last year so that it can be used in the current year. So it's created in the last year. That's the first thing to be kept in mind. Now, further bad debt 3,000 is there. For this entry is not yet made. So first I will make the entry for that. Bad debt to debtors 3,000. So total bad debt will be already 5,000 is there plus 3,000. So my total bad debt will be 8,000. But this 8,000 bad debt, I will not put it in the P&L because you already made a provision in the last year. Now, what is the point of making a provision if we don't use that? So 8,000 bad debt, I don't transfer to P&L, rather I will utilize the provision for that. Now provision is a credit balance. When I'm using the provision, my provision balance will reduce. So if it is reducing, I'm going to debit that account. So provision for bad debt out of 10K, I'll be using 8,000. To bad debt 8,000. Now please understand, out of 10,000 provision, we are using 8,000 provision. So we are still left with 2,000 provision. Keep this in mind. So 2,000 is still in the pocket. 2,000 is there. Now they're telling you, maintain a provision of 5% on debtors. You should maintain 5% of always net debtor. Net. And what is your net? Your gross is 1 lakh. From this 1 lakh, I should minus only the outside bad debt of 3. So my net debtor is 97,000. On this 97,000, I want to maintain 5%. So it should be 9,700 divided by 2, 4,850. This is what I should maintain. But I don't create this much. I want to maintain this much. We already have 2K in the pocket. We didn't use it completely now. So 2,000 is already there. From 2,000, I want to make it 4,850. So the difference from 2,000, I want to make it 4,850. So I'll take the difference. So I'll create a provision only for the difference. So P&L account debit to provision for bad debt. I'll create difference of these two. 2,850. This is how the accounting is going to be. Now, if you see the entries here, P&L account is affected only here. So only in P&L account, how much will come? 2,850 on the debit side. Only one effect. P&L account 2,850. In the balance sheet, your debtors will be 1 lakh minus outside bad debt 3,000 is there. Remove that outside bad debt of 3,000 minus a provision for bad debt. When you're minusing this provision for bad debt, in balance sheet, you should never minus what you created. You should always minus the balance available. Balance sheet is a sheet which shows the balance that is available. So already I have 2,000 in my pocket. Then I created 2,850. so that I have 4,850 in my pocket, and that is what I should minus in the balance sheet. So whatever is already available, sorry, whatever is actually available, remove that. So in the balance sheet, my debtor figure will be 1 lakh minus 3,097 minus 4,850, which is going to be 92,150. Okay, this is example number 4. Case 5 is the last case. With that, bad debt discussion will be complete. Again, you have debtors of 1 lakh. 5,000 bad debt is there, already would have been deducted. 10,000 provision is there, it means it's created in the last year. Further bad debt 3. So first I'll make the entry. Bad debts account debit to debtors 3,000. Now your total bad debt will be 5,000 here plus 3,000 here. 8,000 is my bad debt. I don't transfer that 8,000 to P&L. I'll better utilize my 10,000 rupees of provision. Out of that, I'll use 8,000. So the entry will be provision 8,000 to bad debt. So out of 10,000, 8,000 utilized. So we still have 2,000 in the pocket. Still, it's same as the last case. 2,000 is still there. Now they say you should maintain 5% on data. This is also same. And 1 lakh minus 3, 97,000. On that I should maintain 5%, which means 4850. I already have 2K with me, so I'll create only the remaining 2850. So P&L account debit to provision for bad debt. The difference between 2000 and 4850, I'll create 2850. Same as the earlier case. Now we have an additional adjustment wherein they say maintain one more provision. But this provision is for discount on debtors at 3%. See, whenever we want to give discount, we don't give discount to all debtors. So we give discount only to the good debtors. Which means when I'm calculating the provision for discount, first you should minus the provision for bad debt. Then whatever figure I get, only on that figure I'm going to calculate provision for discount. So now what we'll do, we already know the net debtors is 97. From that 97,000, I'll remove the provision for bad debt, that is 4850. So it is going to be 92,150. On this figure, I'll calculate 3% provision for discount. So 92,150, on that you calculate 3%. So that will be the figure for P&L account debit to provision for discount. And this will be, can we say, just calculate the figure and take this figure. So P&L account debit to provision for discount, take this figure. Now ultimately, if you see, your P&L account impact will be 2850 for provision for bad debt and whatever you get for provision for discount. Total this, and this will be the impact in profit and loss. And in the balance sheet, ultimately your debtor will be from 92,150. You'll minus one more provision, that is provision for discount. And that will be your balance sheet figure. So with this, we complete adjustment number 10, which is bad debt related adjustment, which is very, very, very important from examination point of view. Moving on. Next, adjustment number 11, goods destroyed by fire. There are 3 different cases in this. Let us take up by one by one. Case 1, you have lost 10,000 fully insured. So whenever the goods are lost, it's a loss for you, debit that. So goods lost 10,000. And if the goods are lost, if you remember, in trading the account, we deduct that from purchase. So purchase is going down. So goods lost account debit to purchase 10,000. This is the first one. But this entire 10,000 is fully insured. If it is fully insured, I have to get the money from the insurance company, which is like an asset for me. It's like a right for me. So I'm going to debit an asset called insurance claim account because I have a right to get the money. And if I'm getting the entire 10,000 from the insurance company, my loss is effectively zero. So I'm going to reverse this goods loss. So goods loss, I'm going to reverse because there's no loss for me whatsoever. That's it. Now, if you look at this entry, we are going to have two effects. Effect number 1, this 10,000 in trading account, we will minus from purchase. P&L account, there is no effect because there is no loss for me. And this insurance claim of 10,000 will appear on the balance sheet asset side. Okay, this is fully insured. So trading account minus from purchase, full 10,000. And in balance sheet, show the insurance claim on the asset side. Case 2. Same example. Let's say the goods are destroyed but not insured at all. If the goods are lost but not insured, so the first entry will be goods lost to purchase. Same entry. But now, because the goods are not insured, entire 10,000 is lost for you. So the entire 10,000 is going to be transferred to P&L. So P&L account debit to goods lost. Now, if you have a look at these two entries, there are going to be two effects. In trading account, we will minus from purchase. Profit and loss account, put it on the debit side. Next one. Goods lost 10,000, insured for 7,000. So can I say this 7,000 is like asset for you and 3,000 is like a loss for you? So the first entry will be goods lost account debit to purchase 10K. The trading account lo minus. Insurance claim 7,000 is an asset, show it in balance sheet. Whatever is not insured, 3,000 is a loss, put it in P&L. So P&L account debit to goods loss. So now totally there are going to be three effects. Effect number one, trading account deduct from purchase entire 10K. Profit and loss account debit side 3,000 whatever is not insured. Balance sheet asset side 7,000 whatever we have insured for. Okay. With this, I've tried to cover all the important adjustments in this video. So please revise all the adjustments. In the next video, we'll take up some difficult questions, which I personally feel are very important from examination point of view. See you all till the next video.